Welcome to Tradespoon. My name is Vlad Karpel. I'm CEO and founder of Tradespoon, and we were talking about two-legged strategies for option traders. If you have a bullish bias, we already discussed how to execute debit call spread or credit put spread. Now, what if you have a bearish bias? How can you take advantage of that information? Let's talk about credit call spreads. So let's take a look. Again, selecting a strategy is very important. You have to pick the stock to trade. You have to be correct in terms of directional bias, up, down, or sideways. But the most important part is selecting a strategy. So if you are bearish on the stock, you could always sell credit call spread. You execute when general feeling toward the asset is negative. What are some of the characteristics of credit call spreads? Low risk, low reward, and low requirements. Allows you to participate in more expensive names. Trade gives up some upside potential in exchange for a chance to recover premium. Notice that higher probability of success compared to long puts. If you have a bearish bias, you could buy a put, but executing credit call spread reduces your cost basis, hence improves probability of success. Let's talk about setup. You sell in the money call with a lower strike price. You buy out of the money call option with a higher strike price. You always use the same underlying asset. Same contract expiration based on analytics. We are looking at 50 to 75 days till expiration. And you select strike prices based on probability of success, where we provide you with different tools to do that. One is the probability calculator. One is the stock forecasting tool. Let's go a specific example. Strike price selection. You can look at the probability of success if you go to Mind Tools under Tradespoon. Expiration months, again, 50 to 75 days. Maximum loss occurs in case your own and stock goes to the upside, that's point B. Maximum gain occurs in case you're right and stock drops to point A. Your break-even point is between point A and B, where you are intersected with the x-axis. And obviously it's a directional trade, so you're directionally short on the stock. How do you calculate return on capital? With bear call spreads, you pay the cost of the long call out of the money options, and you earn proceeds from the sale of the short call, that lower strike price. What is your cost? It's the difference between the strike prices minus the original premium that you received when you executed the trade. The maximum gain occurs. That means the gains limited to their original proceeds. So the maximum gain is the upfront credit that you receive from the sale of that credit call spread. Maximum loss occurs. What does it mean? What's the calculation for the maximum loss? That's the difference between the two strike prices minus the original credit that you receive. That is your maximum loss. And break-even point we already covered. This is the middle point between those strike prices. And again, you can find more information if you participate in our webinars. I encourage you to go to tradespoon.com, open up a free trial to learn more about Tradespoon technology that help you become a more successful trader. You can also participate in our webinars where we can provide additional information. And stay in touch with us on our social media channels, Facebook.